Good morning. Welcome to another secular bull market update. I think March is the last time I did one of these. Been holding off a bit just to see what the markets did, and because I'd normally have done this probably a month or 6 weeks ago, but we've got some exciting stuff happening in the markets. So what do I do here? We look at the big picture long-term analysis of where the stock market is. So we look at cycles, but we also look at a little bit of fundamental stuff. Before that, as always, have to tell you that everything we cover here today is general in nature, and there's no personal or specific advice that you should take from this session, but we are going to be looking at some up-to-date data. So the objectives of these sessions that I do twice a year is to really step back and look at long-term secular, and that means long-term, ultra long-term, and I'll put the timings into perspective in a moment, and just see where the equity markets are placed. And I use quite a bit of technical analysis, and we look at a few fundamentals as well. Remember the requirement that past performance is not a reliable indicator of future performance, but cycles and trends do exist, and they persist longer than what we would think they would, and meaning that there can be a lot of bad news out and markets will continue to rise, and vice versa. There can be a lot of good news out and markets will fall. So we have to live by the axiom of anything can happen, as we've got on the sign behind me. So is the nature of today, the question we're asking is the secular ultra, which is the ultra long term, is the secular trend still up? Is the secular bull market still in place? So we're going to explore that in some detail. Now, just a little bit of background. I typically just state this, but I'll just show you some proof of this. Back in March of 2013, I wrote an article. It was, in fact, written in February, but published in March. And what else? The headline of that was History-Making Event on the Horizon. And I won't read all this now. You can look at the recording and watch it. But this is the Dow. It was approaching an all-time high. This is the S&P 500, also approaching an all-time high. And you can see the secular bull and bear markets here, which we'll explore in a little bit more detail in a moment. And the gist of the article was the pros and cons of a breakout to an all-time new high, and whether that would happen, and was that going to be a history-making event that we'd look back millions of times. Lots of people would look at going back. Now we are that was in April of 2013 that breakout actually occurred, which we'll look at as I said in a moment. So we've been going for 10 and a half years, more than 10 and a half years since that breakout occurred. So that is the background to this, and I've been examining and looking at where the secular bull market has been ever since, in either blogs and in webinars like this since 2017, doing every couple of times a year. So that's what we're doing. That's the background, and we're continuing to analyze the story as it unfolds. One of the first things we always look at is the presidential election cycle. That's 1927 to 2018, some 90 years of just averaging out what the presidential cycle was of years 1, 2, 3, and 4. And let's have a look. Now that stops in 2018. What's happened? 2019 was a third year of a presidential cycle. And this year, 2023, was the third year of a presidential cycle. So how have they gone? Well, 2019 didn't surprise. When according to the script, S&P 500 and NASDAQ up. But this year in 2023, that's to a couple of days ago. It excludes today's data in the US. In fact, it's only 1 day out. Up, and they're both up another half or 0.6% again in today's session in the US, which is not included in those. So it hasn't surprised. It's done. It's gone according to the script. But we've got year 4 coming up, which has been typically, let's go back, it's the second best year. So let's see what happens next year, because there's a lot of bad news that people are talking about coming up next year. And the wall of worry, which I always start off with here, and look at what people are talking about. But let's just go back and paint some pictures of what has happened in the past, just so we can try and take our minds back there, and how experts, so-called experts, and predictions have been made. And this is the next stock market crash, why many pros think it has already begun. Dated February 2013, which is when I wrote that article. There were people looking at analysis and going, gee, maybe we've got a history-making event here, and this thing's going to break out, and we're going to start a new secular bull market. But there were people saying, maybe the next market crash has started. Remember, the markets had run up from March of 2009, had a big run up, And that was, some 4 years ago, and people are saying this is the end. We're going to hit our heads on the top. That's what the markets look like at all-time highs, and there are plenty of reasons to be terrified. And market pros to declare that an amazing 4-year rally in stocks is over, and that we're on the precipice of a new crash. And you can read that in your own time. And then let's march forward 3 years to March 2016. Epic collapse and recovery, stocks first quarter. So again, this. RBS, a major global bank, told clients to sell everything in March 2016. And the market could fall 75%. And there it goes on. All this is the wall of worry stuff. Oil in free fall, bank stocks tanking, US dollar was climbing, delivering a big hit on earnings in US multinationals, and so it goes on. Global markets turn turbulent and wildly volatile. So there's always going to be bad news, and there's no shortage of it, and nor is any shortage of it right now. Let's march forward to January 2021. Man who called the 2008 stock market top says we are in a real humdinger of a bubble. And since January 2022 was a bad year, but this is Jeremy Grantham. I'm doubling down because as prices move further away from tended accelerating speed and with growing speculative fervor, of course my confidence as a market historian increases that this is indeed the late stage of a bubble that is beginning to look like a real humdinger. Bad news. There's always going to be bad news around. So let's have a look at some of the bad news that's around at the moment. 2 wars on the go. China continuously flexing its muscles around the world. Inflation and interest rates are still relatively high. I use the word relatively because they've been far higher. Bank failures and bailouts, still talking about what happened in the US and cover-ups that happened then haven't solved the problem, and potentially that's going to rise its ugly head again. There's been massive addition to government debts around the world during COVID-19, and the magnificent 7, or should it be 8, they're just really roaring and leaving the rest of the market behind them. Small and mid caps are underperforming, and so we'll have a look at some of that in a moment. But people are saying it's overbought. This whole bull market is only based on a few stocks, and recession coming to the US. It's gone a little bit quiet on recession, but it's still the makings of everything there. In fact, some people argue by the real definition the US is already in recession, but and some of the fundamental stuff that gets examined there is pointing towards a recession. However, there are still some people saying maybe we'll avoid the recession. But the point is, we don't know, but the bad news is there and it clings on. And I did put this in the session I did back in March. I mentioned these, but guess what? They're still there. They haven't gone away. The noise is getting louder and louder. Nouriel Roubini, great stagflationary debt crisis. He made a lot of noise about it last year in 2022, and he's gone a bit quiet now, but I'm sure as soon as we have a little bit of retracement in the markets, he'll spring to the fore again. Harry Dent has been on about his 80% decline in the US market, and he bases that on the fact that the NASDAQ100 back in when the tech wreck happened, and from basically the NASDAQ kept on going a bit higher, but the market started falling over in March of 2000, and the NASDAQ100 had an 82% decline in its bottom from the top in 2000. So that's what he's referring to, and hey, of course it could happen again, no problem with that, but we've got to set ourselves up to try and not participate in such a decline. Stan Druckenmiller, famous for working the US, the British pound, made a lot of money out of that, and he's saying stocks flat for 10 years. He called that, it's coming up in a couple of months' time. It's 2 years ago that he called that. Dan Ferris, sideways for decades, like Japan 1989. That's what he's saying. It's like Japan 1989. That's what we're going to have. Sideways for decades, no new highs. So there's a lot of negative noise around, and the recession is building. So that sets the background, and the wall of worry will always be there. A little bit of terminology. Secular bull bear markets. People are always asking, what does that mean? It means ultra long term, if you like. There are 17 to 18 year cycles. Is typically people that have gone back and looked over this for centuries, and there's the Klondike cycle, which is a 54-year cycle, and the secular fits into that, and then you get primary and bull markets, primary bull and bear markets that fit into within a secular bull or bear market. So they're kind of shorter, can last cycles of half a year to 2 years, and also called cyclical bull bear. Then you get secondary bull bear. So these are happening in all time frames all the time. And in fact, you could go down to tick charts, you could go to 5-minute charts and 20-minute charts, and there are up and down trends happening all the time time within all of these bigger cycle trends that we're looking at. So now we are going to step back and look at secular bull bear. We don't have enough data to go to the 54-year cycle, but we're going to examine this. So a little bit of background. Some of you may have seen some of this already, but it's no harm, and I certainly get a lot out of looking at this every 6 to 7 months or so, because it really does give me that big picture and get you to step out and really consider where you are, not only with where the markets are, but where you are with your investing, relative to where you are in your journey with investing, and how old you are, where you fit into with your investing, and where you are in your life, at what stage you're at. So we have this ongoing thing which I've called the wall of worry versus the secular market cycle. And of course, no one wins out all the time. There are times where the wall of worry wins out and we see retracements in the markets, and there's other times where the market climbs the wall of worry. And at the moment, it looks like it may be just peeking its head out above the top of the wall, but a bit more of that in a moment. So let's step back. I'll go through these pretty quickly. It's a reminder for most people, but there will be a lot of you that are probably seeing this for the first time. That's 1930 to current. In fact, 1 day out. I haven't got the 0.5% rise overnight in here. And let's just put this into perspective. Secular bear market lasted 20 years with a 60% fall, which was the last major trough of that secular bear market. Market rose, had found resistance at these levels over here, and then eventually broke out. So the secular bull market, we'll talk about that in a moment. The next secular bear market, 13.8 years with a 49% fall over there, and a 36% fall over there over 1.5 years, 1.7 years there. That was a 5-year 60% fall. And here we had 13.1 years of secular bear market before the breakout there in April of 2013, and I wrote the article just at that point over there, just before the breakout, and a 49.2 and a 56.8% over those periods of time were the three major secular bear markets we've had. In between, we've had secular bull markets, which runs from the breakout to the peak, the first peak. Now, we don't know at the time that is going to be a secular bear market, but we need to analyze as best we can, and it can take a couple of years to confirm that, maybe even longer, really, until that peak again is reached and resistance is found. There is really the only time we can confirm that we are definitely in a secular bear market, but we can look for signs along the way. 18 years from the breakout to that peak. Next secular bull market, 17.6 years from breakout to peak, and the one we're currently in at the moment has been going for 10.7 years and a 200% rise. Right, so let's have a look and see. We obviously have not up to the time frames of those previous two secular bull markets. Now, a small sample, I know, but this has taken nearly 100 years to develop. So that, just looking at that 200% there, 10.7 years. Let's have, where were we 10.7 years in this secular bear market? Well, that secular bear market of 10.7 years, we were up 286%. So not quite as strong as that. And that did have the 1987 crash and that 286% rise. And that secular bull market from the breakout there in 1949 on the way to the 66 top over there, a 226% rise. So not far off, pretty similar. And we know that patterns don't repeat exactly, but they are similar and similar enough to be able to make investment decisions from. Now, it's the other thing that people always talk about. Those articles, remember the 2013 article where people were calling a crash, a 75% crash or whatever it was, and we had this 4-year really strong bull market run. Well, the 4 years they were talking about was from this trough here to that point there in March of 2013. And what people were saying is we're on the precipice of another fall. They were looking at another fall like this. But those who had studied the big picture like this would have known, no, maybe there's a chance that we could have a history-making event and we could break out over here and start a new secular bull market. So what I'm doing here is I'm measuring the rise from that trough. Because a lot of people have been measuring, they've said, the 4-year bull market, the 6-year bull market, the 10-year bull market, they're all measuring from 9th of March 2009 back here on the trough. So when we got to 2019, it's 10 years, henny penny, the sky's going to fall on our head. Of course, it didn't happen. So measuring from that trough, 14.8 years, 600% rise, including the COVID-19 crash, 33.9% in 33 days. At that, so measuring from the last trough over here, that was a 25.5 year cycle and achieved a 2,353% rise. And well, I'm not saying it's going to repeat exactly like that, but just putting that big picture perspective in place is we're saying that from a technical analysis perspective and a cycle analysis perspective is that we could have a lot longer to run, maybe even as much as another 11 years in this secular bull market that we're currently in. And at the moment we are approaching new all-time highs, which we'll look at in a moment, because this is going to be pretty important for a secular bull market to continue. It's going to have to break above. All indices are going to have to break out to the upside and continue rising. The 1987 crash happened in the middle of this secular bull market, 33.5% in 55 days, and this one from that trough there, took 8 years for this to break out, but it was a 26.7 years it took from trough to peak, and a 1,333% rise. So, taking the worst case of these two, I know a small sample as I keep saying, is that we're not even halfway through equivalent of what this secular bull market was going from the trough down here. Again, just perspective we're looking at here, no dead certs and no predictions. We have no idea what's going to happen in the future, but it just gives us an idea to have some information and data to step back and look at when the news cycle is looking at days and minutes and really blowing up all the negative news, because that's sensationalist and sells newspapers and gets eyeballs watching. So we need to step back all the time and just let whatever is being accentuated or emphasized in the short term and see that in perspective with the long term. The Kennedy slide was the sharp fall that happened in that particular secular bull market, 28% in 196 days. Now, a lot of people at the time when this secular bull market breakout occurred back here in 2013 were pointing to the Shiller S&P 500 inflation adjusted index. So this is the S&P 500, which Robert Shiller adjusted for inflation, and you can see the shape obviously going up, but the shape is different, and it will go up because it's obviously stocks, and there's an organic survivorship bias that's actually built into an index. So it is going to rise, but of course the timing of when it breaks out and how it rises is what everybody's trying to interpret all the time. So just to put into perspective, the 1950 secular bull market breakout occurred when the Shiller inflation adjusted S&P 500 was down here. It hadn't had a breakout. It came later. The 1982 secular bull market breakout on the S&P 500 cash index occurred when the Shiller inflation adjusted S&P 500 was right here at its trough. And for 2013, it occurred here. Then that breakout happened some 3.5 years later is when the Shiller S&P 500 inflation adjusted index broke out, and that's where it is at the moment. So that's still rising. Some market valuation ratios. The S&P 500 to GDP ratio is called the Buffett Ratio. Just to put into perspective here, I've shown this before, because what people look at when they analyze this is they say, oh, look how high it is. It's right up over here, and it hasn't been higher since 1940, and therefore it's overbought. Well, firstly, times are very different now to what they were then, and what we don't know is whether stock markets, because of how they've adapted and changed, are able to sustain higher, for instance, Buffett ratios or any other ratios that we analyze and look at. Because if we look at all of those, really the market should have crashed ages ago, because they all indicate overbought. So let's try and put some relative perspective into that to make it a bit more meaningful than just say, oh, it's all overbought, the market should have crashed, and therefore we shouldn't be in it. Because that's just not going to get us anywhere while it keeps on rising and all the valuations say it's overvalued. So let's try and put a bit more sense into it, a bit more common sense into it. So what I've overlaid here are the secular bear markets periods, and just now looked at the Buffett ratio relative to that, and we can see that was that secular bear market which you just looked at, and it's obviously the 1929 crash. So we had a massive run of the S&P 500 to GDP ratio rising up here, and then it fell. Obviously the S&P 500 fell, so it's going to fall relative to GDP because the price of the S&P 500 is falling, and then it rose. So then during the secular bull market, this ratio rose, and then hey, guess what, the next secular bear market it fell. Why? Because stocks were falling, and then it rose again, and then it fell, and now it's rising. So looking at this relatively, it's actually doing what's quite normal. What we don't know, because what we're trying to do is in absolute terms try and make sense out of the level that this is at compared to history, and say therefore compared to all of that it's overbought and therefore it should fall. And the whole way along here, people have been analyzing this and saying it's overbought, and especially when it's broken out above the previous highs. So my take on this is that it's rising at some stage when the S&P 500 falls relative to GDP, and GDP also can rise. So if GDP is rising quicker than what the S&P 500 is, well then obviously this is going to fall. So at the moment, this is pretty normal in my view. And yes, when the bear market comes, which you've got to look at price action first up for, because people look at these things to try and predict. And then once you predict, you expect. And once you expect and your expectations don't work out, that's where we get ourselves into all sorts of trouble. And in fact, it's one of the themes of the 4-week process plus mindset training intensive that David and I just finished a couple of weeks ago, which I'd urge you all to do. Talk a bit more about that in a moment. Is we've got to take this information in from a big picture perspective and try and put a relative interpretation on it. What we don't want to do, because it is good to know the background and the big picture, it does give us a sense of confidence and a bit of a platform and some stability in how we think, but it also helps us, and this is the primary reason I do this, it helps us to stave off all the short-term negative stuff that gets so emphasized and sensationalized, and we can put it into perspective and go, hold on, but let me don't get afraid of what all these people are writing, because I can put it into perspective and I can give myself, my inquisitive, curious brain, an answer that says, hold on, let me just go back to price action and stick to my rules. And that is why I do this. So I'm trying to put a bit of sensibility into the sensationalism that you read. So let's go and now look at the S&P 500 PE ratio. This is the raw PE ratio. And again, the same thing, because people are saying PE ratio valuations are so high. The index PE ratios are way up. They shouldn't be that high, because remember, PE ratio is basically just a comparison between prices of stocks represented by the S&P 500 and their earnings. So if the price is higher than the earnings, then you're going to get these high valuations. So this is raw, and I call it raw because we're going to look at the CAPE, the Shiller adjusted one, in a moment. But effectively, during these secular bear markets, that's what we had. We had a falling PE ratio because the S&P 500 is falling, and it's falling quicker than what either earnings are falling, earnings per share falling, or earnings per share are rising at a quicker rate than what the S&P 500 is falling or going sideways. So, but then what happens is that during a secular bull market, it rises, and then it falls during a secular bear market, rises in secular bull market, and of course what people get stuck on is the level of these. And what we don't know with the changes in technology and everything that's going on in the world is we really don't know what level of PE ratio or market PE ratio that the market can sustain. And so we look at this relative to the past. With all the changes we got it's too high, therefore it's got to fall. And then we predict, we get sucked into all the commentators talking about it, and we make really poor decisions with our timing and our investing in the market. So putting some relativity on this again is what we see is in a secular bull market, which we're currently in, and we'll analyze that in a bit more in a moment to confirm that we really are in it and what the signs are that we have right now at the hard right hand edge, is that we have a rising P ratio, which we should have in a secular bull market. And when we do get into a secular bear market, eventually when it does come, we're going to have this falling P ratio. But at the moment it's rising. And I think there's been enough proof now over the last 20 years, because this level I've got here, you've heard of the rule of 20. I've got this red line sitting at the rule of 20. The rule of 20 since 100 years was that when the market got to a P ratio of 20, it was going to fall over and die because that was overvalued. Well, we've got for 30 years now, 1990 there, 1995. The S&P 500 PE ratio has spent nearly all of its life above the rule of 20. So that rule a bit long in the tooth? Well, we don't know. We'll see. But at the moment, it's okay for the S&P 500 PE ratio to be above 20. Now, these high PE ratios got Robert Shiller to go and do the PE10, which is effectively a 10-year average PE ratio, and he called it the CAPE. It's a cyclically adjusted PE ratio. And so I've drawn a line over here really to try and put a relativity on where the previous one was, where it was showing, because these were all showing when it got above here, we started getting relatively high levels, overbought levels, if you like. There were an upper band, a resistance level, if you like, for PE ratio, and of course then the market always fell from there. But now we've been above it, so he adjusted it. He wrote a book on it, because now we needed a new answer for why the market was able to sustain and keep on rising with such high PE ratios. So I've now tried to just eyeball Mark 2, put where that line might be on the Shiller PE10 ratio, the CAPE ratio. And I put it at around about 22.5. This goes back to 1880. And you can see, even with the Shiller adjusted, and he wrote that book, I think, round about 2000 or early 2000s, Irrational Exuberance, all that sort of stuff. And guess what? Even since he wrote that book with his adjusted, it's gone and defied what he came up with anyway, and has spent most of his life above this average and way above over there. So what I've overlaid on here was where these the previous secular bear markets were. You can see the secular bear markets, and effectively we just have same as we have with the raw P ratio, a falling CAPE ratio during secular bear markets and a rising CAPE ratio in secular bull markets. And what we have now is a secular bull market, and this is rising. So I think the jury's still out on what kind of, what level, what number, absolute number the market can sustain with either a Shiller PE ratio or an S&P 500 PE ratio. But sure, it is still relatively high compared to where it was back here, but at the peak of where the 2000 bear market, the secular bear market started, it's not as high as that yet. So what does that mean? Does that mean that we could sustain it that high, or could we even go higher? I don't know. But at the moment, these are all really background information. What I'm trying to do is put a different view, a different angle on what other people write about with these things and put a different perspective on it. Right, interest rates, 10-year Treasury yield. Been a lot of talk about that with inflation around, putting it into perspective, also going back to 1870. By the way, all of these charts are available on the link that I've got at the bottom over here, so you can go and look at this yourself. And there the secular bear markets are, falling interest rates. Oh, look at this. Interest rates, sorry, so that was falling interest rates during a secular bear market, rising interest rates during a secular bull market. Oh, that's a bit of a turn up for the books. It's not supposed to do that. But it did. 1950 through to 1968, interest rates rose in that secular bull market. Continued rising very strongly. High inflation in the early to mid 80s, late 80s. Secular bear market, interest rates rose. Textbook stuff. Secular bull market fell, interest rates fell. Textbook stuff. Secular bear market. Oh, interest rates were falling in the secular bear market. Stocks are supposed to go up when interest rates fall, but they went down. Sorry, not according to the textbook. And now what we have is mainly sideways most of the secular bull market we've had, but obviously this inflation hitting at all-time low and interest rates here, and then rising, but still below the average. But it's the relativity that people get worried about. And relative to where they were near zero to where they are now, obviously with inflation, it's sentiment driven. It has obviously had a major effect on the year of 2022 on it was the number one factor probably. It may be overemphasized because we can see that markets can rise or fall and don't have to go according to the textbook. There are other factors at play. Now just comparing 10-year Treasury, which is the same chart we just looked at along the top over here, to earnings yield, because the play always on stocks versus bonds has been what the yield is, and if you could get a higher yield in bonds or than what you could get in the stock market, then obviously it makes more sense to go and put your money where you get a higher yield in bonds. And at the moment, just quickly, and I should have highlighted this, but the 10-year Treasury is yielding 3.95. It's had a bit of a drop from around about 5 or just under 5. And the earnings yield on the S&P 500 is 3.82. So they're much of a muchness. But you can see that the yield has been falling in the stock market just in the last, and it's been rising on 10-year yields. But just looking back historically, secular bear markets, yield fell. We just looked at that. And earnings yield rose. Earnings yield fell during the secular bull market, so it fell quite a lot there. And then during the secular, why is that? Because obviously earnings yield has price built into it as well. So when price is falling, then yields can go up as earnings per share. So we have this phenomenon that really doesn't tell us anything except that and also a couple other things to point out here. The long-term average of earnings yield has been much higher than what it is, and now for the last 30 years the S&P 500 has been in a declining dividend yield state and a declining earnings yield. Why? Could be because stocks have been overvalued, but I don't think they've been overvalued for 30 years. But there is a trend there of earnings per share being lower and prices being higher, and that there hasn't been as much demanded from the stock market in terms of earnings yield. Why? Because people are going for price growth. And so the stock market has become a growth machine in terms of price. And maybe just, compared to the 100 years before that, has not stuck to the valuations as closely as what they did in the past. And I think we maybe are spending, and people might accuse me for saying this as being a technical analyst rather than a fundamental analyst, and I did start out as a fundamental analyst in the 1990s, is that the data is showing us is that people are putting more emphasis on the price, and we've had major retracements in stock markets while that has been happening. In the 2000s, NASDAQ retraced to 82%, that NASDAQ 100, and 72% in the NASDAQ composite. And we've seen the S&P 500, as I showed you, 50% falls. And despite that, the growth machine has continued up. So not saying that nexus is broken, but it's something we need to take into consideration when people are putting valuations on the stock market using fundamentals like this. But that is kind of more or less to textbook, but not telling us much at this stage, except that we could certainly sustain higher or lower earnings yields, and we could also sustain even higher interest rates as well, and the market still continue up, with, of course, short-term down and retracements along the way. Right, this is another interesting one. Retail money market funds. This is a new one that I haven't shown before. And really what this shows is money market funds are typically investment accounts where money is parked for the short term. So like a trading account that is sitting with your broker. And so what they do is they put the money into the money market. So this is an indication of cash that's on the sidelines that would, most of it would have, not all of it, most of it would be in the market had if people felt that's where it should be rather than being in cash. And you can look at cash as being one of your positions, if you like, in the market. I don't look, sure, I do that when the market's falling, but when the market's rising, I want to be 100% invested. But there are people who say, no, one of my positions is cash. And there are money management regimes, if you like, money management processes you could use to do that, but not going to get into that right now. But let's just look at this as a way of saying, when this is when this retail money market fund is rising, it means that money's coming out of the market. So starting bottom left over here, this rose from, what have I got you, 1995, about 400 billion. This is in billions of dollars, and it rose to about 900 billion over this period here. Now, this is the year 1995 to 2000, and the market rose 165%. And while it was rising 165%, people were taking their money out of the market. Why would they do that? Well, because they were trying to pick the top, right? Without doing any analysis. They didn't write it out because they didn't have any money management or risk management or timing regime where they would sell out when they got a timing signal to do so. So the cash doubled. The cash out more than doubled while the market rose 165% in the last stages of that bull market running into 2000. And then the market fell during that period. That was one of the bear markets. So that was a primary bear market and a secular bear market. So the secular bear market started in 2000 and ran all the way to here. 2013, about here, is the secular bear market that we showed in the previous charts. And this was a primary bear market. That was the first primary bear market in that secular bear market. Fell 49%. But what happened is cash went. So that's cash coming out, and when this blue line falls, it means there's cash coming in. So it either went sideways. The first part of the fall, there was money coming out and then coming in, but net going across that, there was more money went in during that period of time than came out, right? This is, you'd expect cash coming out doubling when the market's falling 49%, but along the way stayed in or went into the market. And the latter part, obviously the big fall happened over here, and there was a little bit of money that came in that period of time towards the end, but a lot of it stayed in for most of that period of time. And then the cash started coming in. So this is the first rise out of that primary. So the primary bull market started, still in the secular bear market, and cash was coming in and rose 60%. And then the last 30%. Cash came out. So we're talking about from 700 billion to about 900 billion. While the market is rising, it is coming out. And then the market fell 56%. And sure, some money came out, but to the tune of less than 100 billion came out during that 56% fall. So most of the money stayed in the market and got hit with that 56% fall. And then the market rose. So this is this coming out of the second primary bear market. So we've got a primary bull market now coming out of that dip, the one that we saw that really eventually took us out into a secular bull market, and it rose 115% and cash came in, which is great. And then it went sideways. None went in or out, and we rose 50%. And then the last 40%, now this is getting to, so we're getting up to, so now we're into secular bear market has ended round about here. We're into secular bull market here. And now we're going from 2017 to 2020 COVID, is the market rose 40%, but while it was rising, cash was just coming out. And it accelerated here, and so that was coming into COVID, and then cash went in, and the market rose 45% in that time. That is coming out of COVID, which is great. Sideways 10%, market fell 10%. Market the money stayed much the same, and then now's the bit that I really want to show you. So the beginning over here, and so this is showing you that most of the time the cash going in and out of the market actually gets it more wrong than right. And now we've had since May of 2023. Is that no? Sorry, I think that is May of 2023. The market has risen 9%, and the cash has come out. All of this cash, how much cash has come out? 720 billion has come out of the markets while the market has risen from May. That's May 2022. My apologies. So over the last 18 months. So we saw the end of the 2022, and then there's been a net rise of 9%, and we've had 700 billion come out. Now we go back to, I know there's been inflation and there's more money supply and all that sort of thing, but this is a lot of money that's come out. And since November 6th, the market's gone up another 9 or 10%. And it's we haven't got the update of what's happened, the money come out since November 6th, but the market, there's more cash out sitting in trading accounts on the sidelines than what there ever has been. I know there's inflation, but if we go back to just here 3 years ago, just sitting at $1 trillion, is now sitting at $1.7 trillion. So there's a lot of money sitting on the sidelines. And we can see here as well that it doesn't really go much below 600 billion sitting in cash, but this is now getting to 3 times how much there was less than 10 years ago sitting on the sidelines. So why do we cover that? Because that could have a short-term effect. Now, if the markets do break out to all-time highs, well, there's a lot of money sitting on the side. We know Warren Buffett is sitting on something like $175 billion worth of cash. He's made some sales recently. He's got nearly half of his money sitting in Apple in the market, and so like him, there's a lot of people sitting in cash. I'm sure this is 1.7 trillion, his 175 billions in there as well. But people are really going to be faced with some key decisions, because the talk is recession, a really poor 2024, all the negative signs are aligning, and but there's a lot of cash sitting on the side. So if these markets break out, even if it's on the back of the Magnificent 7 or 8, it's going to be hard for the money sitting on the sidelines just to stay sitting there. So let's move on to the markets. But before we do that, let's just talk about recession. And this is the yield curve, the yield curve, the 2-year versus 10-year yield curve, and this goes back to 1986. And whenever the yield curve goes negative, so there's the 0 line. Typically, we are followed by a recession. So the recession is the gray area. So this comes from Fred. You can look this up yourself. Yield curve went negative, recession. Yield curve went negative, recession. This was just prior to COVID, really short recession there. It was a very tiny negative. But look where we are now. And because this has been for as long as most people who invest can remember, this yield curve has been negative so long and so deep that people are starting to take it for granted, and I don't think we should do that. It's an outlier sitting in the background that is kind of just filtered away, but this could very quickly come back and come into the forefront of everybody's discussions again, and it'll probably do that if the US goes into recession. But don't forget that. And so the economists and the fundamentalists who are talking about recession, this is one of their inputs into it, and we shouldn't forget it. My favorite quote during secular bull market updates is, "Bull markets are born on pessimism, grown on skepticism, mature on optimism, and die on euphoria." and it's sometimes pretty difficult to know where we're at with those. But there's a little bit of pessimism, skepticism, and optimism in all different parts of the market. But one thing, and there's even euphoria, and euphoria is happening at the moment in the large and the magnificent 7-8, and the NASDAQ100 is absolutely soaring ahead. So you might argue there's euphoria there, but the kind of euphoria that I think Sir John Tempelton was talking about was when the whole market was going, when everybody was talking about the market, and even people who are never in the market. That's not happening at the moment. And the whole market going would mean the mid caps and the small caps also joining the party and reaching new all-time highs. They're still some way off. They're further behind than what the large cap stocks are, indices are. And so I don't think we anywhere near the euphoria that John Tempelton was talking about there. And I think when you'll be able to feel it, as I say in these sessions, when people who are never typically in the stock market come in and are talking about stocks, and that's certainly not happening at the moment. So I don't think we're in that phase. That's not an analysis, obviously, of any data. That is just really more a gut feel type thing, but it's definitely a valid statement, a valid comment from that, and I think we should keep that in the back of our minds all the time. When is the euphoria absolutely over the top? So let's just look at the secular cycle. Easy to determine the start of the bull of a secular bull, difficult to determine the end of a secular bull and the start of a secular bear. So we've got to look for some objective signs to potentially alert the end. So one of the things that I've brought into my analysis in the last couple of these is the 14-month RSI. So we are now going to look at the S&P 500, going back to the first secular bear market, the 14-month RSI, relative strength index. You can see fell below this oversold area. So I'm going to highlight those and battle to get into the overbought area while the market was going sideways. Did the same in this secular bear market from 1968 to 1982. Away, didn't get to the overbought zone, went sideways, had these. And these are also some early warnings as well. So what we are looking for using these two, and in fact we'll go to the third one as well. You can see oversold getting below the oversold line at the bottom of the RSI is just look where these lines are lined up over here. So there's the first indication back there. There's the first indication back there of the 1929 crash. RSI got below again early on in that sort of area over there. And again, even in this retracement here, the 60% retracement happened there were the signs early. Here was a sign early in the 1968 to 82 secular bear market. There was an early sign over here. It fell below, rose again, peaked there. Another one just before, and here this halfway down in the 74 bear market, it gave some signs. This bear market over here, halfway down, the 49% decline at that stage. So we didn't know that was the top, that was the peak in 2000, and the decline had started. We didn't know whether this decline here was maybe just one of these, okay, one of these that happened along the way, because we didn't know what was coming on the right-hand side. But there was an early warning signal. Obviously, then it fell below and the 49% decline. Then we had another one early that was leading into about June, July of 2008. So what's showing now? Well, no early warning signs yet. Now, this is not, you shouldn't use one indicator, but as you see, I haven't used one indicator so far to try and summarize where we are at the moment. But there are no early warning signals yet using the 14-month RSI. But this having happened in the past, it's no guarantee that the 14-month RSI will give us one when we get there, but it's certainly not at the moment. Let's apply that to the Dow Jones. Similarly, Dow Jones, we've got data going back to 1896. There was a secular bear that happened there as well. All those indications. So we've got 4 secular bear markets we can look at on the Dow Jones. And all these early warning signals were there. And at the moment, there isn't one. Looking at the NASDAQ composite, 14-month, less data here, going back 1971. There's the secular bear, well and truly below. That was the 1987 crash, is it? No, that was after 87 crash, there, 1990 there. That didn't happen, so anomaly, that's why it's in red. And we got an early warning signal in 2000 here as well. It wasn't quite early, it happened quite a long way down. But it was indicative that we started a secular bear market. We didn't know all of this was still to come, but that gave us a good indication that it probably was going to come. Didn't make a new high there and made another one there, so secular bear. Are we seeing any signs yet in the NASDAQ composite? No, have not reached below the 14-month RSI. And so what we were looking at here in this period in 2022 was whether we had a transgression here into the oversold zone. We didn't, and therefore, and that was the trough there we just recently had, and we've got this growth out now. So no signs using the 40-month RSI. Coppock is another one. This is a 14-month indicators, goes back to 2000, and it's a little bit delayed, so it's not one you'd use for trading intraday, but it certainly does give a big picture, and it calls it pretty well on the big numbers. So here's 2000 to 2003, and here, so effectively you go bear market when it crosses below zero, and bull when it crosses above zero. Called it pretty much okay there. We had a fall below here recently, so this was potentially an early warning signal from the Coppock and indicator, but we've now had a rise. So it looks like it's been more one of these in a secular bull market than one of these in a secular bear market. Or here was the indication in 2000 that we were potentially going into a secular bear market. So that happened was applicable to here, but it hasn't followed through. So we've had the rise again. So that doesn't confirm or give an indication that we were in a secular bear market. Let's look at support and resistance zones and some Fibonacci and new all-time highs, just looking at a few major indices. So what I've got here is I've got a Fibonacci that starts at the breakout of the secular bull market, which occurred in April of 2013. So there's the Fibonacci, and we've just undergone in the year 2022 the 38.2% retracement in the S&P 500 of the breakout. Now this is this is a major pause, if you like, retracement, taking a breather that we should have in a secular bull market. You go look at the other secular bull markets, and they had these 38.2% retracements. In fact, in one of these sessions, I went to go and see where they had the first one and how many they had. Now, putting COVID-19 aside, which is a bit of a health anomaly, we came out of that pretty quickly on a steep V bottom. I'd say this is probably the first valid 38.2. We probably might have got close over there, but this is a really major one, 10 years into the secular bull market. So this clean out had to happen, and I know it was a bit tough trading through it, but it is now on the S&P 500, and there's another 28 points it's put on over here, which is not in this, and it still hasn't made, but that black zone at the top there is the resistance zone for a breakout to continue the secular bull market. So what we don't know is whether the S&P 500 is going to find resistance here or not. Now I know it feels like we're in a raging bull market over the last 2 or 3, because every day we're getting green, and our portfolios are going up if you are 100% invested, which you should be, and it feels like a little bit euphoric. Now this is how people felt back in 2013 when we'd had a 4-year bull run, and they said this has to find resistance here. We're going to now have a crash, we're going to have another 50% fall, and all the people were writing that leading up in that first quarter of 2013, and we were looking at, could this be a breakout into a new secular bull market? And of course it was, and that's what happened after the breakout, and we started the new secular bull market. So try and feel like that as well, and keep an open mind without trying to predict what's going to happen. Is that's what could happen here. This breakout could occur here and be just like that, despite all the wall of worry stuff that's going on. But it could find resistance and fall back into the range as well. So that's the S&P 500 on resistance, 38.2%, now approaching all-time highs. I think it was back 2 years ago, just over 2 years ago, that previous peak was established. And let's have a look at, so we had a 25.4% retracement, which is a 38, that was in absolute terms, there was drawdown if you like, but the Fibonacci retracement was a 38.2 from there. So that was a fall of absolute fall of 25.4%. The new breakout, no new breakout, we've got to get above 48.19, and I think we closed at 47.68 or something today. So it's not far off. It's 19 plus 32 is where the breakout is. So that could happen during the Christmas break. And remember that in the US, they only have a short break, not like the Southern Hemisphere countries. The NASDAQ had a 50% retracement of its breakout from the secular bear to bull market breakout back in. Now it broke out in end of 2016. It took another 3.5 years for the NASDAQ to make a new all-time high. Why? Because it had such a deep retracement after the tech wreck. The composite had a 72% fall in value. So now it is lagging the S&P 500 relative to where its last peak was. So it's got to get above 16,212, but this the 60% fall, Fibonacci retracement, was a 36.4% fall from its peak. So that's made up nearly all of that, excuse me. But there's this gap that needs to be filled to break out to a new all-time high. So what we're looking for here is we're looking for at least the three major US indices to all break out above their all-time highs. But the Dow Jones has done that. So it had a 38.2% retracement as well of the Fibonacci run-up from the breakout in April of 2013, and it's now broken above and put on another 0.5% overnight. So it's just snuck out above its previous all-time high of 36,953, which is over there. And so there's the first one. The first one has broken out. Is it going to continue? Let's look a bit further. The NASDAQ100, which everybody's talking about, where the Magnificent 7 or 8, if you look at the top 8 stocks in the NASDAQ100, they make up 60% of the market capitalization of the whole of the NASDAQ 100, not the NASDAQ composite, of the NASDAQ 100. So what did it do? It had its breakout also at the same time as the composite late in 2016 into a new secular bull market. Its peak was reached there, had a 50% retracement like the NASDAQ composite, and has now just snuck out, and again on today's data it's a little bit higher. So it has reached a new all-time high. So NASDAQ 100 has, composite hasn't, S&P 500 hasn't, and the Dow Jones has. Right, let's look for some other support. The German DAX has reached a new all-time high. It has, and in fact I think it was up 0.5% or so overnight as well, and it had a break above 16,290, and it did that, and it's come down, it had a little bit of retracement, and a green bar has formed. Now what you want to see for this to confirm is all of the indices to do what the DAX has done here, come back and test this previous resistance zone, which is now a support zone, and then make a new high. So when we have like a zigzag, a breakout, a peak, come down, a trough form, and then the next peak form above this previous peak, and do that on all the indices, then the probability is going to be pretty high that the secular bull market is going to continue, and it could in the short term continue quite strongly with breakouts when they occur, money on the sidelines, the funds are all caught short, they haven't got their money in the market, or they've been sitting on the sidelines, or they've got it in other asset classes, they have to rebalance to get the asset classes into the risk on, and it has this effect of really pushing markets higher in the short term, and just that's where you start feeling euphoria. So we really are very close to finding out what's going to happen. Of course, if that doesn't happen and these indices don't make new all-time highs, and they don't have a retracement that tests the previous support resistance zone, which is now a support zone, and continue higher, then we could see them all trading back into the range. Now markets do extend ranges, there's no doubt, and this is where they would, if they are going to extend their range, what happen here, they just extend it a bit and then fall back in, because it's not a perfect science. They don't all just go like they have over here. For instance, there is the peak formed, resistance, 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 and it's all very, very close. There's a slight extension. That's why I make this a zone and not a line, is they do extend ranges. So range extension typically happens in a secular bear market where there's a little bit of an extension. You go back and look at the Dow and the S&P 500 of the two peaks they made in the last secular bear market. They all extended the range just a wee bit. So the bulls just push it, and then the sellers come in. So we have to see where the sellers come in here. Now, I can't emphasize this enough. The next 2 or 3, 4 weeks is going to be key to see how these markets respond here. If they're going to make new highs, it's all on. It's risk on, and the secular bull market, despite all the wall of worry stuff, there's a high probability it's going to continue going. If resistance holds here, slight range extension back into the range, and then sellers come in and we move back 10, 15, 20% into the range, that is a very high probability that we are going to the secular bear markets, like all the guys at the big, the Rubini and the Dent and the 30 years or sideways, decades of sideways. That's where those could all potentially come into play. Now, the interesting thing is that the recession is being called, and this is the time I wanted to talk about this. And a lot of people are saying 2024 is definitely going to be the year of the recession, but they did say that in 2022 that it was going to be in 2023, but now it's definitely going to be in 2024. Is that, remember, the economy and the stock market do not move in sync, and the stock market typically leads, right? So if this market does continue high and make a breakout, what is happening is that the market leading the economy and saying, hold on, this recession should have happened by now, and it's all bets off. there's not going to be a recession, we're going for it? Or are the economic factors going to be the dead weight on the market and pull the market back down, and we do have the recession? And of course, nobody knows the answer to that, but this is the tussle that's going on between the wall of worry and what's happening technically in the price action. Now, if you're an active investor or a trader, then you have to go with the price action, because what happened in the breakouts. What happened in the breakouts here, like when that breakout occurred, this is the NASDAQ100. Look at the indecision here when that breakout up, down, and eventually they said, no, this is it. This is the breakout. It just took off. Now, if that happens, then it's going to be very difficult for fund managers to sit on the sidelines and let the recession and the woe is me wall of worry talk overwhelm the price action. But of course, if sellers start coming in now, then and the bulls don't get control, then it could be indicative of moving into a recession, and this really being the end of the secular bull market, or sorry, the first signs of the end of the secular bull market. So very, very important time. The next 3, 4, 5, 6 weeks, this is all going to play out, and a lot of it could happen between Christmas and New Year, which is what happens so often on the market. Just go back and have a look and see what happens to price action in the 2 weeks around about Christmas time. Right, what I also wanted to look at here, I wanted to cover this large cap stocks overbought question. The Magnificent Seven used to be FANG, and everybody's writing about it. So I'm just going to play a little bit of illusion with you here. I'm going to put, first of all, I'm going to put emphasis over here. Now, what this chart is the magenta is the NASDAQ 100. And I've chosen the 100 on purpose because the top 8 at the moment make up 60% of the NASDAQ 100 and nearly 30% of the S&P 500. So they're representing large caps, and everybody's talking about the rest of the market, nothing's happening, and it's all, look at the equal weighted index, the same thing, it's underperforming the S&P 500, and it's all about everything's in these top 7, 8 stocks. So let's just go and examine that. So the magenta is the NASDAQ 100, the green is the S&P 400, this gray is the S&P 500 equal weighted, and then you've got the rest over here, which are probably more representative of the market. It's the S&P 500, the Russell 3000, which is probably, that takes in all of them, all of the stocks. I also put the S&P 1500 over this. I didn't want to cut it up anymore, but it is effectively just the same as the Russell 3000. It's also got the Dow Jones. So the Dow Jones, the Russell 3000, and the S&P 500 are these that are pretty much close over here. So they are representative of the market. The equal weighted typically over the longer term will do better because mid and small caps do better over the longer term than large caps. So that's weighted up there, and there's the mid cap pulling up the equal weighted as well. So this is going back to 1986. I've done a base 100 to July of 1991, which is roundabout over here. Why? Because the indices were all much the same up until then, and then the breakout started happening from July of 1991, and you saw this run up here of tech stocks, which also had biotech stocks in as well. So what happened here was the NASDAQ 100 got to be 4.7 times higher than the Russell 3000, and you can see they're all conglomerate around there, but I chose to be exact numbers, the Russell 3000. And at the moment they are the NASDAQ 100 is 5 times higher than the Russell 3000. So you might read some stuff, and I have read some stuff, so you may have come across it as well, that people are saying it's massively overbought because compared to there, it's now a higher times a multiple than what the broader market is, and therefore everything's going into these large cap stocks. Except there's one little analysis anomaly, is that we are now rating the growth of the NASDAQ 100 and the Magnificent Seven based on going all the way back to 1991, and it has this growth in it as well. And what people are saying is that this reverted to the mean, and therefore you can, which it didn't revert to the mean. Why? Because reversion to the mean would mean the magenta would have to come all the way back down to the orange here, which it didn't. So if you want to be a half decent an analyst, then what you got to do is you got to bring it back to a point where they were much the same. And what I did was I brought it back to March of 2009, which is the bottom of the bear market during the secular bear. It is the bottom of the primary bear within the secular bear, and that gives us a good 14 nearly 15 year run up. So let's measure that now, and it's now only 2.3 times. So to compare apples and apples, to get to the 4.72 that we had here, we really, now you can see that was 1991 we started, so that had a 9-year run up and 9-year run up, and now we've given this 15 years and it's 2.3 times. And if you then just, so you can see it more clearly, I've just taken the left hand side over here. It's still the same base. I'm starting March 2009, 2.3 times. So to be equivalent to what we had back in the tech wreck in March of 2000, it could be the Magnificent Seven could double even more, and to be relative to back then. Now, I'm not saying we're going to repeat to be relative back to the 4.72 we had back then, but markets do run in similar fashions, not exact, and to at least be similar, it could put on a lot more. So if you're seeing, and again, it's perspective and just, I think, analyzing it properly, I think this is a better interpretation of the analysis than trying to measure now back all the way to 1991 and then compare it to the 4.72. I think this is a better base relative analysis. So it could, what this is saying is that the NASDAQ 100 or the top 7 or 8 could go a lot higher. And that would, that with the money sitting on the side and the 1.6, the 720 billion that's basically gone to cash in the last 18 months, sitting on the sidelines, and a breakout happen, people being caught short, being underweight in stocks because they don't believe this market, well, it could really take off. So where to from here? Thresholds to watch. Stalling at all-time highs, we've got to watch to see. So I've spoken about whether these indices, these major indices, whether we see a stalling there. If they all get above, we've had the DAX, the NASDAQ 100, and the Dow Jones have all broken above so far. We've got to wait for the S&P 500, the NASDAQ composite, to see where they go. And also on that, the small cap stocks as well are still below. So and I haven't done that analysis yet because I still got some way to go. It's pretty obvious, and I will be doing that in the when I do the every 2 week what's up with the markets, where we haven't brought the small and the mid caps into it, but we will do that in time as well. They've had a good 2 or 3 days, so they're getting closer. And so look at the stalling at we want to see all the indices get above there to really get this breakout if it does happen. And then look at the support levels as well if we don't make it, because we could see retracements down to those support levels if we don't make it. But if this doesn't break out and continue, then it's going to be a major analysis event that's happening here that could be seeing the start of the secular bear market. Now remember, if we do break out and get above the all-time highs, remember after that, like we've had now in the secular bull market, 20 to 35% declines are okay, they're fine. We just don't want to get, when we start getting to 40 to 45, that's not okay. Typically they'll go further and get to 50s and 70s and 82s like the NASDAQ 100 did. We're not in that territory yet, but that's what happened. That's one of the defining factors, differentiators between a secular bear market, is we have much shallower retracements in a bull market than what we do in a secular bear market. Keep an eye on the 14-month RSI for an early warning, and also keep an eye on the Magnificent Seven compared to the Russell 3000 as to what that multiple is. If we do have a breakout above that multiple, creep up higher from 2.3 to and higher. We don't know where the turning point will be. It won't be exactly 4.72, but it can probably get above the fourfold. So the secular bull market is still intact for now. There are no signs that I can see in anything that I've analyzed. There's a bunch of other things I've also analyzed outside of here, analytically, from a technical perspective, price perspective, and I can't see any signs to say that the secular bear market has started. The wall of worry stuff is always there. Every time I do these sessions, the wall of worry material is different and also the same sometimes, but the wall of worry isn't going to go away. And as I said, this is really an arm wrestle between wall of worry stuff and the people that are the doomsayers. Remember, the doomsayers all eventually do get it right. We just don't know when they're going to get it right. And it's valid to take that in, but we've got to try and be as objective as we possibly can and not get affected by the noise. Where to from here? Nobody can predict the future, and I do talk a lot about this in the 4 week training intensive that we just finished. And please, I'd implore all of our customers to do that training. We've had fantastic feedback. Even customers who've been customers for more than 20 years have done it and have said it's just taken their thinking and understanding of the markets to a whole new level, which is what our intention was. So please, I implore all of our customers to do that. It's in the education center, and you'll be getting emails about it coming up. But in there, I do cover this. I cover the effect that prediction and doubt and fear and hesitation and reaction to noise has, what effect it has on us, and how it just can take us out of the game and takes us out of the opportunity flow that the market has. And that's the last thing we want to do, because we come to this market to the volatility in the market is what gives us our return. So we've got to learn to love and embrace that volatility and work out how to execute, and it's all a mindset thing. Analysis sure is one of the things. It's only 10% of the picture in my view. Once you have a system and a process in place, the rest, once you have that process, 90% of the game is how you think about the markets, and it's all covered in detail in that course. And we can't predict the future. And you can't continue changing your decision criteria. Short-term volatility, biggest killer of long-term goals, and you have to prepare a plan. And in that plan, you have to trust, come what may, execution. So expect the best, plan for the worst, and prepare to be surprised. Are we going to be surprised with this breakout and continue to new all-time highs? The story is going to unfold on a day-by-day basis, and you've got the price action in your charts. Just keep an eye on those indices that I've covered today, and you won't need me to tell you. You'll be able to, and I know a lot of you have been watching these for the last 6 years, and you have that in your minds now. You understand that big picture. You can see it. The picture's there in your head. Use that picture, and then just come back for short-term updates and follow the story. It's a fantastic story. It's a great and exciting story to be part of. And the great thing that makes it exciting is that if it does fall in a heap and fall back into the range, we've got a plan to know what to do and to be peaceful and calm and cool and collected in the process without without making knee-jerk reactions and hesitating and being all confused and etc. etc. Why? Because we've planned for the worst and we are prepared to be surprised, and we, in the meanwhile, are going to expect the best. So prepare for the secular bear market, the worst. What are the best strategies? Well, the secular bear market's eventually going to come. We just don't know whether it's going to come next year or in 4, 3, 2, 5 years' time. But we want to be prepared for it when it comes. Is our index buy and hold ETFs the best solution for a secular bear market? Absolutely not, because in a secular bear market, when it comes and it goes sideways, for 13 years, the only growth you're going to get, well, you won't get any growth, but over that 13-year period, or 14, or 15, or 16, or dare I say it, 20-year period, there's going to be big volatile movements, and what you want to do is time those volatile movements. But in a buy and hold index ETF, you'll go sideways, and you'll get no gain whatsoever, zero. Only dividends, but dividends is only going to take you up probably net 3 or 4% on top of the top. Buy and hold stocks, not good, and balanced funds, even worse in secular bear markets. So what is it? Is discretionary, intuitive, subjective, active investing the best for secular bear markets? I would say most definitely not, because that's when the most confusion reigns. So avoid most of a large primary bear market is really what you want to do. So you saw the secular bear market sideways, big 50% falls. You want to avoid those 50% falls in the secular bear market, those primary bear markets in the secular bear market, and you want to minimize exposure, mostly go into cash, and you want to make the most of the primary bull markets, because there were the two primary bear markets that happened in 2000 to 2013 on the S&P 500 were followed by 100% run-ups, and those are the ones you want to get a big chunk of the 100% run-ups and be in cash mostly during the 50% falls. So you maximize your exposure. I remind you of this is a Warren Buffett quote: in a year when the general market had a substantial advance, I would be well satisfied to match the advance of the averages, but do not be in it when that happens. Secular bull market intact. Anything can happen. It could end next year. It could end in 2030. 2030 would be 7 years away. That would take the cycle from 10.7 to around about 17.7 years, which would match the length of the first two, roughly 17 and 18 years, the bull markets that occurred there. So it could match those. And well, we don't know. It could happen anytime. So I could be sitting here for the next 6 years doing this session and still be saying secular bull market intact, secular bull market intact. I don't know. Or we could be into a secular bear, in which case we've got our plan and strategy in place. I do not need to know what will happen next in the market in order to make money. Fundamental truth number 2, anything can happen. Fundamental truth number 1. And that's what we've got to live by and put plans in place. Expect the best, put plans in place for the worst, and then be prepared to be surprised. And during the secular bull market, expect 10 to 35% falls along the way. And that really, more than anything else, is a mental preparation. As long as you got your sell signals and everything, but we're going to go into drawdown. We have to prepare ourselves mentally for those when they come. Summary: understand the big picture, which hopefully I've done today. Keep the S&P 500 long-term 100-year chart in mind at all times. Understand where we are relative to that. You've got the analysis which you can download into Beyond Charts, so you can call up the charts that I showed you today. They're all sitting there in your analysis. If you download that analysis, you can see those. And why we're in the market? Why? Because it's an endless stream of opportunities, and we want to maximize and take advantage of those, but at the same time mentally be prepared, be mentally fit to be able to handle the times when there are retracements. That's effectively the whole game of investing, actively investing in the stock market, just said in that statement in a nutshell. So you've got to overcome the noise, overcome the 4 primary fears of losing, being wrong, leaving money on the table, and what's the 4th one? Leaving money on the table, losing, being wrong, fear of missing out, and also leaving money on the table. And those are not analysis. You don't overcome that with analysis, you overcome that with how you think, with your mindset. Use a systemized process, stick to the mechanical decision support system. And I've got the only way in inverted commas there, because Mark Douglas, those of you who've done the mindset, the intensive, the training intensive, the process plus mindset training intensive, he said the only way is to have no wiggle room. That's the only way you can get your mindset to being a consistently successful trader. And there it is, the 4-week plus mindset training intensive. I remind you, all of our customers, please do that. We've had fantastic ravings about it, and it will take your trading to a whole new level. Any questions? I think there are some questions here. Right, Jermaine. Yes, Gary, the volatility provides us returns, but when these corrections come through, we tend to give up a large proportion of our profits. I'm looking to take some profit with stocks close to resistance levels. Thoughts, please. Well, I think I've answered that question, Jermaine. The only answer I can give to that is that you are now saying that you know what's going to happen by doing that. So you are projecting your mind into the future based on, and you are predicting what's going to happen in the future. So you're saying at these resistance levels, the market's going to fall. Okay. Now you put yourself in no man's land when you do that, because if the markets don't fall and buyers come pouring in, why? Because there's cash on the side and they're underweight stocks. The breakout happens, all the indices go. It's going to be a sharp rise. And with you being profits off the table, now you're going to say, I want to take some. How much? So what does your plan say? I'm going to take 10, 20, 30, 40, 50% off. And then the biggest no man's land you get yourself into is, if the market continues going up, what do I do with this cash sitting on the sidelines? Do I now go and buy? And what are the signals? What are the alerts to go and buy? What brings you back into the market? So Jermaine, it's just fraught with a whole lot of problems when you do that. And so you live in confusion land. You're living with your mind, projecting into the future, trying to predict what's going to happen. Fundamental truth number 2 is, I don't need to know what's going to happen next. But you only can live by that principle, by that fundamental truth, if you have a set of rules that guides your decision making. And so in fact, the best answer I can give to you is that go and do the whole of the 4-week process plus mindset training intensive, because what you're saying in that question is telling me that you haven't got it yet. And I know you've been a customer for a long time, but if you are having issues with it, then maybe you've got too much money in the market at this time. So maybe you cut back and you actually are able to then follow your process 100%. You can execute flawlessly. And executing flawlessly is not taking money out when you don't have a signal to exit according to the rules of your edge. So maybe you need to do that. But those answers, the real answer would be in the 4-week process of mindset training intensive. Please go and do that. If you've got time over the holidays, do it. I've heard we've got customers that are listening to podcasts of doing it without seeing the actual graph or the slides and stuff like that. You'll get benefit out of just listening to it, listening to the audio. But whatever, that is the answer to your question. Okay, John, thanks. Outstanding, pleasure, Jock. Right, thanks as always, Gary. You looked at US and German but what is the picture of the main world markets, China, UK, Japan, etc.? Right, I do those every couple of weeks, Jock, and I've purposely stayed away from that because I don't think they're as meaningful. China is certainly going down. I don't think China plays a role at all in the Chinese indices, plays a role at all in analyzing what we do with our money, unless you specifically want to play the Chinese market. But in terms of the bigger picture of where we're going in equities, it's pretty minor, it really is. Japan certainly does, but there's just too many indices. Japan also, when it comes to secular bull bear market, their price, their index, their cash index is just way out of kilter because of what happened in 1989. We still haven't got back to that high. In fact, analytically, I've now said let's just look at the recent highs, and it's bounced off that. It hasn't gone above it. But I cover Japan every couple of weeks, in the what's up with the market sessions I do. And the other question which I thought which you were going to ask, which you didn't there, was what about Australia? Well, Australia will follow. We've underperformed dramatically for some time now, the S&P 500, but it will get caught in this. There's no doubt. And what Australia needs to get a market like we had in 2003 to 2007, coming off the bottom of that, where the All Ordinaries rose 150%, rose as much as the NASDAQ did in that period of time, whereas the S&P 500 only rose 100%, is we need the small and mid-cap resources to come into the game. And they've been continuously held back for a whole bunch of reasons, but Australian market won't get as strong as the American markets until that happens again. Some people are saying it'll never happen again. I don't say never, but those set of circumstances will come, and we'll have the All Ords, the ASX 500 will outperform the others, because we'll get these small to mid caps playing a role in it, but we haven't seen much evidence of that yet. Donna's saying the PE, I need glasses here. I can't read your question, John, my apologies. I need to make this bigger, I can't. The PE ratio is achieving higher highs and higher lows, so it's in an uptrend, absolutely. This text here is very faint, sorry. No picture, okay, that is all done. So those are the questions. Any other questions? Near resistance, certainly is, Bruce. It's had a couple of really big days, so it's near resistance, and there's on the charts, if you've got the analysis beyond charts of my charts that you can download, it's pretty good, yeah. Okay, lots of other thank yous and outstandings, pleasure. I think I've answered all the questions, so we'll end it there. We've been going for a good chunk of time, and summary, I think you should have it, is pretty obvious, and we'll be back to do another one of these in about 5 or 6 months time. And in the meanwhile, I wish you consistent, objective and peaceful investing.